Building the perfect ETF portfolio and dividend investing. That's what I'm talking about today on the podcast with Milla. He is an ETF and dividend investing expert on YouTube with over 20,000 subscribers. Let's jump into it. This is going to be a good one. Right now, if you had a gun to your head, you're like, you have $10,000, you never invested. What do you buy with that 10 grand to get going to set yourself up? Yeah. What is it?
Right now, it would just be 100% into either two buckets. Well, first of all, for me, if you just gave me 10 grand, I would just put it 100% into an S&P 500 index fund, specifically an ETF. So VOO would be my obvious choice. Everybody knows that. Everybody knows that that's my answer. But if you are like the correct answer from a financial advisor standpoint, from a fund manager standpoint, CFA, professional investor standpoint,
diversification
would be VT, which is like a total world ETF. So you got US and international exposure. So either of those two, but I'm going to go with VOO.
How much you put into VOO? Like if you had to put a percentage allocation, you don't have to give up the number, like just roughly.
Oh yeah. So I invest $6,000 a month, roughly. It could be a 10K a month. It could be like 3K a month, but on average it's about 6,000. I have percentages here that is written down. So right now my portfolio is at $185,000. 20% of that is, so I have three accounts. I have a Roth IRA, a 401k, and a taxable brokerage account. So in my taxable brokerage account, I have the highest amount of VOO. Last time I checked, which was this morning, was like $96,000 into VOO. And then, which makes 75% of that portfolio or that account. And then I have VOO as well in my Roth IRA, which is at 20% of that account. And that is about, I believe, $4,000. So it's what, $100,000? Oh, I just realized $100,000 to VOO. And in terms of the monthly allocation, it's about $4,000 a month usually goes to that. And usually when the market dips pretty hard, which was last month and the month before that,
April,
I could be up like 10K deep into it. But
yeah. So it's kind of similar to me. So in Canada, it's VFV, same as VOO. But I actually buy VOO as well. It depends on which account because we have the RRSP, which we get that 15% withholding tax waived. So like on dividends, if we buy a US stock, we have to pay 15% on those US dividends, right? But if you put in this RRSP account, which is like I think it's your 401k where you basically don't pay tax now, you pay tax later. That correct? Right. So it's the same as that. So I'll hold VOO in that account because I got US currency. But then on my TFSA, where I do get taxed 15% on dividends and I get taxed now, but I don't pay tax like ever later. Like I get taxed on income now, but whatever I put in that account, capital gains doesn't get taxed at all. I buy VFV, which is the Canadian hedged version of VOO. I guess your dollar cost averaging, you just like buy every month, or is that what you're doing?
I buy on a weekly basis. So I'll kind of go in mentally with a number, or I guess kind of feeling out as long as I just get that money into the market or into those ETFs, and I'm pretty happy. But usually it's a weekly basis and it's kind of spread out. Like I could just deploy all my capital once on a Friday or a couple of times during that week, and kind of depends on kind of how I'm feeling. Just depends on, is earnings going to come out from some big tech, or is the CPI going to come out, kind of navigating the market. And it's not timing the market because I'm still getting the capital out, but just more of how can I get the best bang for my buck on my dollar, right? Kind of, I guess a couple weeks ago, people asked me like, you're buying the market less. Like, why is that? I'm like, I'm still buying, I might be buying once a week on a Friday just because I'm going to be averaging up. But, I deployed a ton of capital when markets were down because of tariffs. I think it was about $18,000 just in 1 month. And so that's why I always preach to people, dollar cost average, right? But always try your best to raise capital, have some cash on hand, whether it be, less than 5%. But with the beginning of the year, I was like 15% cash. Now I'm at like 5 or 6 because I had that cash, but it was still giving me monthly interest. And when markets dip and pullbacks occur, I just pull the trigger confidently. And I think that investors would be doing themselves a disservice not to keep up with macros and keep up with what's going on around them versus kind of just blindly buying, which is fine. But in terms of being a, person who's keeping up on ETFs all the time, and I love it so much, and I love the stock market. I think for myself and a lot of other hands-on investors and investors who just want to invest in the market, they try to keep up with it as much as possible.
I think a lot of people, though, I know from mine, some of them are hands-on, some of them just want to set it and forget it. But I still say have a dollar cost average approach, like beginning of every month or whatever, just buying it whatever the price is. I never did that. I'm doing it now though. After this recent thing, I'm going, maybe I'll start doing that with VOO or VFV. The only thing is I got lucky. I sold a large position in VUG. And what crashed? Everything in VUG, but I sold it at its all-time high, and it was a two-factor decision though. I was holding it in my TFSA, and it was a US stock, US currency, US dividends. I was like, I don't want to have it here anymore. If I'm going to have anything that's like a US stock, I'm just going to put them all in my RRSP just so I can avoid that 50% withholding tax. So I sold it for that. And then I went, damn it, these are all tech stocks. And this thing is going to burst soon. Like this bubble is going to burst because it was just everybody was overvalued. So I was like, I'll just sell it. And then, I don't know, like maybe 4 weeks later, everything went to shit. And that's why I had all this capital just loaded up and I just went on a crazy buying spree. Did you sell anything at an all-time high last year? Did you get a chance to, or are you just buying and holding everything you're doing to sell? Yeah.
Yeah, buy and hold. I think that's the strategy I preach. And I think that it makes it easier from a tax perspective as well. Yeah, I rarely take gains. I think the only time I sold gains was for reinvesting that capital into a different ETFs. I was in the Qs, which is the Nasdaq 100 by Invesco. Ticker symbol is QQQ. And then when they released a lower expense ratio version, kind of like the mini index, it tracks the exact same index, but the expense ratio is 0.05% cheaper, which is a 25% cut on the original expense ratio. I just sold it all and reinvested that capital back into the new fund. But in terms of the whole overall strategy, it's definitely buy and hold. And I think that makes it easier for me just to track everything, and it makes for a good content when you have a big balance and a big gain and you're not selling.
So for your Roth IRA, what's the yearly amount you can deposit in there? What's the limit?
So
it's the
I
same.
believe it's under age 50. It's $7,000.
8,000 over, right? Or something?
8,000 over, correct.
And what did you buy during April, by the way? Anything outside of your standard, load up on VOO? Did you buy anything you think is unique to you that like maybe you're interested in specifically?
Yeah, so my buys were obviously heavily VOO, and then my next biggest buys was SCHG, which is a Charles Schwab US Large Cap Growth Fund or an ETF, and that's basically Charles Schwab's version of VUG by Vanguard. And then my next big buy was Triple QM, which is the Nasdaq 100, DGRO and SCHD, super lower allocation in the portfolio, but still gotta show some love to them. And then I guess my favorite investment in April was my first time investing outside of stocks, or should I say ETFs, and that was into angel investing. So I invested money into a startup, which was a lot of fun. Do a lot of due diligence. Yeah, that's a funny story because I was given the opportunity to do it, and read the pitch deck. And in college, I took a class on venture capital and startups, and did some work with how startups work, how to start a company, how to start a business, and then how venture capital works with startups raising capital to fund future growth. And when it came to the opportunity, I kind of remembered how seed rounds work and pre-seeds, and I guess how all that operational and back end stuff goes into investing. But then when I'm actually given the opportunity to invest, that was a different story. So I did a lot of due diligence. I even flew down to Vegas, which happened to be when I kind of confirmed my investment over dinner with an individual at the company, and made the phone call and got the wire down to Canada. So then,
what caused you to pull the trigger? Was it them? Was it that individual? Was it the management team? Or was it just when you reviewed everything, you're like, this makes sense? Like the numbers just made sense. Everything made sense.
Well, I guess one thing I have is I have an advantage that other people don't have with understanding how the business works. So I'm an ambassador for the company, and I kind of know how everything works. It's basically an investing app, social media investing app. I think it's social media, but social.
Can I say what it is? You mind? I think it's Blossom, right? Is that the one?
Yep, Blossom.
That's what you invested in?
Yep.
That's a hell of an investment, man.
Yeah.
That's a smart one. And they're aggressive.
Yeah.
I'm seeing them before. I knew you got in on it. I didn't know that's how involved you were, but I knew about them before we spoke about it.
Yeah. And I was given an opportunity with Brandon Beavis.
That's a good one.
Back in August, so to be an ambassador for them, and it's been exponential growth for them as a company, but also myself as an ambassador to bring users to the platform. And I knew everything, how they made money from the monthly subscriptions to the institutional money, and all the data they have. So when I went to Vegas, it was kind of more of getting a feel of how one of the big people, a part of the team, kind of give me a brief rundown on how it works and what they're going to use the capital for and why they need capital. And yeah, pull the trigger. And I think that I pulled the trigger at about $24 million USD valuation. And if I were to invest in it a year ago when they first raised money, I think the valuation was at like 12 million. So you would have hypothetically on paper, doubled your money. But I bought in at I think they were at 250,000 users. Now they're at 300,000. So hopefully you could see some good profit. But I think for them, their biggest need for the capital was, of course, ad spend, and they
Yeah.
are expanding now to the U.S. So you're going to be seeing them on TikTok ads, on Facebook ads, on YouTube ads, and whatnot. So they're definitely having some aggressive growth and sticky users. And when I was given the opportunity to invest in it, I obviously jumped onto the wagon.
That's, to be honest, that's a good investment. Like I probably would invest in that as well. I want to pivot a little bit here because this is what I'm interested in. I have in a few weeks, I think like end of May, I have someone who's an expert on covered call dividend investing.
Yeah.
You're going into that now. We spoke months ago, and you're like, hey, I'm gonna ETFs go more into covered calls. I want to hear about this because you're the ETF guy. You're the guy who safe and reliable and stable and long-term investing. This seems like the opposite, and you're young. So I'm like, why do you care about dividends at all? Like, why are you all capital gains? Just talk about it. I guess I want to hear.
Yeah, totally. In terms of the pivot for the channel, I would say it's more of I see an opportunity for people to be educated. So why not go into learning more about monthly cover call ETFs and now weekly and educate people. So in terms of why people would invest in it, it's simply not to beat the S&P, because with a covered call, when you sell it, you're also limiting your upside, you're capping your upside. And when you're doing the premiums on it, of course that's going to be generating income. But in terms of outperforming the underlying asset, it simply won't do that, just because you're foregoing that upside in the NAV of the underlying asset, because you are selling the cover call. Now we could get into the risks of it and pros and cons. Investors love these types of cover call ETFs because, one, you see a double digit yield usually. It's about, I would say, 8 to 14%. Some could go up to 100. Yeah, seriously. But I guess a healthy range is about 8 to 15%.
Yeah.
And people use it for income. So instead of buying a lower yielding ETF or a stock and relying on just mostly the share price appreciation, what the cover call ETF would do is it would distribute premiums, which are in the form of basically mostly unqualified dividends, and be distributed as income to portfolios or to investors in the portfolio, where they could take the income and use for expenses, or take the income and drip it back into the ETF or the stock or the ETF, and do whatever they please. But it's definitely a trending topic, and for myself to cover it, it's definitely something that I feel would be a disservice to investors if I don't cover it. Now, will I ever invest in one? I'm gonna say never say never, but for now, no, because in terms of total returns, 99% of the time you'll get a better return just investing in the traditional S&P or traditional index versus going to these covered call funds. However, that's not always the case. Sometimes you'll see some covered call ETFs that track an underlying stock that's very volatile. Like, for example, you got MicroStrategy is a good one. That's been a beast. That one could sometimes outperform the S&P, but I believe over a long enough period of time, if you're not writing those covered calls, you're not generating taxable events, because people don't know that with a covered call ETF, you're generating more taxable events, which is the distribution of the income. So if you're just if you're not writing the covered call and you're just buying a traditional ETF, whether it be dividend, whether it be growth, whether it be S&P, you'll have higher total returns because you're letting that money compound instead of coming out of your basically coming out as income or distribution.
To simplify it all, to my thing when I looked at covered call ETFs, and even this thing I was doing with Hamilton, was if you're not retired, don't bother. It's like, it's for, you're retired, you got $1 million, you don't want it, you don't care anymore. Throw it on a bunch of high yield dividend. We're from trusted sources, people have been around for 10, 20 years that pay on time, pay monthly, pay bi-monthly or whatever, and then just live off those dividends. When you're like, I don't care about capital gains anymore, I'm 65, 70, whatever, and I'm just want to coast now and get paid my 14% off 1.5 million or something. Like, that was like the only way I saw it making sense. Or you're just in my scenario, I just have money sitting there, it's just dying to inflation. I have an emergency fund, I don't ever touch it, I don't invest with it, I don't care. It's just if my house catches fire, I got a ton of money to go, fix my house and buy a car and do whatever I want to do. It's really there not to touch. So that was the only two scenarios. But this person I'm interviewing lives off of it. He's probably my age. He's probably 39 to 45, somewhere in that range. He's got like $1 million in him and he's living off that, and he's making $30,000, $40,000 a month. And I haven't done enough research to be like, what is he doing? And is he growing his portfolio? Like it's a giant question mark in my brain because it's just so different than how I actually operate. I'm writing a book, and you'll laugh on it. It's an investing book. Yeah. And it teaches everyone how to invest and how to make $1 million portfolio. And it's 1 page long. It's a 1 page book. And it's called The Only Book You'll Ever Need About Investing. And it's 1 page long. Because I realize it's essentially all it really takes to this, like, if you're someone who's a beginner investor, like, here's a page of stuff that you just follow this and then walk away. And if you just do it every single month, your dollar cost, you'll just come out with this much. And depending on what age you start, right? A part of that was in order to not pull your money out of your investments, because I'm a long-term holder for the most part. When I buy ETFs, I'm a long-term holder. Maybe not so much when I buy individual stocks. That's maybe 5-year horizon, maybe sometimes 10. But when I buy ETFs, I have an emergency fund though. I have money set aside where I go, no matter what happens, I'm good. My business could go under. I don't care. For me, it's over a year worth of, I know how much it costs to me to raise 2 kids, manage my lifestyle, pay for all my assets, do everything. I have a year just like sitting there that I don't think about. I always say, hey, try to get 1 month locked in, get up to 3 months. And then from 3 months, if you're really good, get up to 6 months and then throw it in like a high interest savings account or do something, let it work for you a little bit, but they just have that money sitting there. Do you have any of that set up? Like, how do you approach investing from that financial management aspect of it?
Yeah, I guess for me, I'll get paid and I'll set aside a budget for how much money I'll be investing or set aside to invest, so that whenever I get paid, the first thing I do is transfer the money that's needed to be done to my brokerage accounts. And then with my 401k though, that's automatically taken out of my paycheck.
Yeah.
So I stashed away about 11% of my pre-taxable income from my 401k into VTI, which is just the total stock market. So you get, I believe it's a few thousand stocks all in one ETF, from small caps to large caps. And in terms of the overall strategy, it's mostly just getting that money, and whatever is not working for me, at least for now, that's left over. Usually I like to have about 1 to 5% of my money in my brokerage account in cash. Reason why is because I make income that is not taxable or not taxed yet. Going to tax these incomes, I gotta pay my fair share of taxes. So I'll have that in a Vanguard money market fund, which will generate me it's been paying about 4 to 4.3% interest a year, which obviously could go up or down with rates. So when rates go down, that rate will go down. Rates go up, that rate will go up. Whatever is in that little money market fund will just get taken out and bought into ETFs, and what's left over, I guess, stays in there and will generate some yield. Now, I wouldn't invest what's left over in a cover call fund, because people don't know that you also do carry a lot, if not most, of the downside. So let's say you're buying a cover call ETF that tracks the S&P. S&P pulls back 8%. This one could pull back 8%, sometimes 8.5%. It could even pull back slightly more than the underlying, but usually it should be slightly less, like, just because you get cushion from the premiums. Why would I have my money in a cover call fund when I'm not controlling the market? And at any given moment, if the market pulls back, this underlying cover call ETF will pull back as well. And yes, you'll get distributions, but sometimes the distributions are super volatile. So you can get paid pretty good 1 month, you can get paid pretty bad the next month. But there are different ETFs now that are innovating where you could get paid a pretty stable income every single month despite market volatility. So I feel like just keeping it simple. So I think of my money market fund like it's basically like it holds it into short-term US treasuries. So it'll be super stable, generating my income, my interest every month. And then what's left over is going to ETFs. So I just try to get that money, deploy as fast as possible into ETFs before my next paycheck. And of course, I'm gonna have some cash in there because I got to pay. I don't know when my tax is gonna be next year. This year it's about 4.2K. Next year I'm thinking 8. So I gotta have some cash.
You're in what? You're like mid to late 20s or something? How old are you?
24.
Jesus Christ. Okay, so that's crazy. So I'm old compared to you for sure. But I wasn't thinking about any of this at 24 years old. And when did you start investing? At 18?
17.
Like right when you, what, how old?
17. I was like just about to be 18. So like 17, but I invested like $5 first.
How'd that pop up on your radar? I came from a generation where nobody talked about this. So when the stock market, when people mentioned it, it looked like voodoo. It was just like, that's a bunch of charts. And what is an S&P 500? Like, you just see like the NASDAQ, you're like, that's gibberish. And that's just what rich people do. And it's science I'll never understand. It's only for the rich, not for normal people. It's super complicated. And it's almost discouraged. It's like, if you do stock market, you're gambling. And, I did get lucky. I got into it just through advertising, got me to the stock market. And so I got really lucky and I got like a crazy education on it. And that's what started me. And that's when my income really started exponentially growing. But I got lucky. I fell into it just through advertising, right? You're saying you're 17 or turning 18. Was it YouTube? Like, how did you even get introduced to this?
Yeah. So in terms of YouTube, there wasn't much content from what I remember back in the day when I was about to be a freshman in college. But leading up to that, when I was like 14, 15, 16, I think as early as 13, I would ask my dad, how do I get rich one day? And he would
Yeah.
always tell me, you got to make money in your sleep somehow. And then it kind of
Yeah.
would tell me, okay, how do you make money in your sleep? You invest. Okay, well, that's a big word. What do I invest in? And he would
Yeah.
always, his big strategy as well as S&P 500, but he's in a mutual fund, which I get it, old school.
Yeah.
But
Yeah.
but now there's ETFs, so now I'm in a Vanguard ETF. He's in a Vanguard mutual fund with the S&P.
Yeah.
So he would just tell me like, you need to invest money, invest money, invest money, buy and hold, and it was just that. He never told me what's in the S&P. He never told me expense ratios. He never told me how taxes work in the investing. He never told me about dividends. He just told me like, you need to work hard and work, but also need to stash away money and invest the money. So I guess he kind of let me have my fun. I would say I had quite a bit of fun in high school and quite bit of fun in college. But when I really learned about ETFs was, I guess, my senior year of college. I took a class in personal finance. I took a class in investing. They actually had the classes in personal finance and investing at my university, which was UC San Diego, UCSD. And there they taught you everything personal finance, from credit cards to retirement savings to taxes to investing. And they kind of gave you like the general scheme of it. And I remember like beforehand, I would research, so I would read a lot of Wikipedia, which was kind of old school now, but
Yeah.
Wikipedia had everything on investing, and I would be in a car rides with my buddies because we would be traveling across the country to cross country races, and I would just be reading Wikipedia about stock market. And I read a couple of books. My favorite book is by Tony Robbins. Any of his books on money and investing, simple S&P 500 strategy, how to do it around it. So when I was reading those books and kind of just reading for myself, and then I went to these classes, I was like the only student just like answering all the questions and how compound interest works and how diversification works and ETFs and mutual funds and whatnot. And then I took a minor in finance, and from there I was able to take more courses on like robo advising, which was super new, and that obviously involved investing, and then a couple upper graduate school courses, even though it wasn't grad school, but I took some upper level courses on investing in the stock market, but also, like I said, venture capital and startup investing. So UCSD had a really good foundation for investing. And then in terms of which investments to make, because they never told you tickers, they only told you how lump sum works, DCA
Yeah.
works, how volatility works, beta works. They kind of told you like the technicals a little bit, but they can't legally tell you what to buy. So what tickers to
That's
buy,
true.
the different types of funds. And then the minute I got out of school, or I guess a couple months before I graduated, I remember telling my dad, like, I would always talk to my buddies about investing, and they always told me like, dude, you should charge for this. Like, you're really good at this. And of course, I made a lot of mistakes back then, but
Yeah.
I feel like I was above average knowledge and about the stock market. And I was like, okay, I think I could start a YouTube channel about it. There's a couple of big YouTubers on ETFs, but I think I could eventually be one. And just started talking about it and made some bad videos early on in terms of the quality and maybe what I know now versus then. And yeah, just always constantly learning and evolving in ETFs. And my biggest, I guess, the people I would like to thank, I don't know if I can say their name, but some CFAs at big companies, I want to say like Capital Group and PIMCO, and fund managers kind of took me under their wing behind the scenes of my channel, telling me like, hey, this is how covered calls work.
Yeah.
This is the pros and cons of the S&P 500.
Mhm.
This is how diversification works. This is how a true diversified portfolio works. So behind the scenes, not only was I making videos and learning about ETFs and investing in them, but I also broadened my sense of how the market works and how to construct a good portfolio for people that is correct on paper. But like I said before, everybody has different strategies, goals, and preferences. So
Yeah.
when I make videos on my channel, I try to kind of lay people like the pros and cons of this strategy, who it's for, the risks of it, and kind of give a whole and complete. Everybody knows I like to say a full and complete breakdown of this ETF or this strategy, and I just try to do it day in and day out.
You're fantastic at giving all that information on your YouTube channel. Are you that friend who everyone's just like, this guy just talks about investing nonstop and he's just trying to get us all to invest?
Yeah. So
Are you?
when I first started, it was more of, oh, I want to invest in the stock market. Like, oh, Marcus, that guy. I probably constructed some bad portfolios back then, but
Mhm.
in terms of, it was always, market, just talk to markets you want to invest, or talk about money, because I feel like I'm pretty aggressive as well in terms of my business life, in terms of the whole YouTube entrepreneurship route and then my corporate life as well. So I probably work like 80 hours a week, but I love it so much. And people would say like, text Marcos if you want to invest, if you want advice on investing,
Yeah.
advice on getting a job, advice on credit cards, advice
Yeah.
on financial advice, just not buying a house. That's not my thing. Real estate's not my thing.
Yeah.
And now it's almost like I can't get a break because people are DMing me, people are
Yeah.
messaging me on Blossom, people are emailing me, people got my phone number, I know, from like college.
Yeah.
And they got YouTube comments. And so I can't get back to everybody now, but back then I could help some buddies and friends and they know they can message me. But now I got probably like 200 under messages just today or something.
That's crazy. That's impossible. Did you ever think about like possibly doing, or maybe you do consulting, actual consulting? But
I'm gonna say you guys should well, maybe in the next couple of weeks you guys will see something on the channel. But yeah,
I had a comment in one of my videos being like, hey, what kind of fund should I set my kids up with? How do I secure my children's future? We have an RESP account here in Canada, like an education fund. Like, is this a good choice? Blah, 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 blah. And my advice was like, yeah, do that. I have that for my kids. Maybe not the most efficient, but the government matches your contributions. I'm sure you got something like that in the States. But my actual comment was, oh, make sure your kids are financially literate by the time they turn 18. So like when you're talking about your dad and him telling you the basics of, oh, S&P 500, invest and hold, that's it. Planted the seed. And that was solid advice, by the way. That's Warren Buffett. That's all he says. He's just saying, if Warren Buffett's saying it, your dad's saying it, it's got to be good advice. That's where I think you guarantee yourself little 24-year-old rich kids, like who don't start rich. You built your wealth. You work hard for it. You take people. I just wish that they taught that in school. You went to college, university, you went through this whole funnel of stuff that you just described of like getting more educated. It's like when you get out of grade 12, I feel like everyone should be taught that. Like, it's good to know the square root of whatever, but also teach me about tax law, teach me about investing, teach me about compounding interest, teach me about all that stuff. Because like I said, I got lucky. You're just younger, more ambitious than me. Your dad gave you that nugget. You ran with it. That's rare. But you look at your friend circle. Was anyone else doing that? You were probably the outlier in your high school friend group, at least. Now you're probably surrounded by a lot more people. It's just, do you notice a lot more people your age though, compared to like my generation, are more financially literate, more savvy? Do you think just access to technology, or do you think everyone's just like YOLO and just throwing money around, trying to look cool and not even thinking?
Yeah, we get into that topic. I feel like a lot of people my age, at least, I live near Irvine. I'm not gonna say exactly where I live, but I live near Irvine. I'm in LA all the time. And in terms of what people are financially literate, I would say no. I see a lot of people take out so much debt for a car. You see people put stuff on credit cards. I hear people. I'm in group chats with people, which I love them by the way, but they're driving a M4 on a huge honking loan on this high interest rate for the car, and they have no equity in the car and depreciating asset, and the clothes they wear, designer, or their spending habits are horrible. They make $1,000, 1,200 goes out of the account. So I would generally say that no, a lot of people my age aren't financially literate. That they even know what the right thing to do is. I feel like most of the time is save the money because they don't know how to invest. So maybe save the money or just spend less than you make. And to get rich is just either spending less than you make and investing that difference, or making more than you spend and then investing the difference too. But how, I guess, my life, my dad, especially because my mom, bless her soul, but she's a homemaker her whole life, and she's from Mexico, and she came here and she got her, she's completely a citizen, and,
You have to,
right? But
no one's coming for you.
in terms of like, she doesn't know much about financially literacy and stuff, but she knew how to raise some good kids, right?
Yeah.
And my dad's job was to instill a fire in his kids' hearts and work ethic. So I mean, for example, like my dad would always see him growing up, come home, I'd be playing with some Hot Wheels or something, and immediately eat his food and go upstairs and work.
Yeah.
And he's still like that today.
Yeah.
Maybe a little bit less, maybe a little bit more chilled out. So just seeing that. And then we never took a vacation. I just talked to somebody earlier today. Like I told him I never took a vacation. I still haven't taken a vacation in my life. And I think it's from that mentality that my dad instilled in me of that hard work and grit day in and day out. And of course, having like a good, for in terms of my work and my business and what I do is, of course, I'm going to have some nights where it might go easy, but I'm super hyper competitive and I want to learn as much as I can. My dad always told me, learn. So if somebody has an advantage on me, whether it's financially, whether it's some interest I have, whether it's something I don't even have an interest in, I always try to take food for thought and learn from them. And even when it comes to YouTube, like if there's somebody who's smarter than me, I've learned a lot of from people that maybe aren't as financially literate or maybe don't have as much subscribers or whatnot. And I could definitely respect and learn from people. But yeah, and even my dad told me like I never got my first credit card till last year,
Wow.
and he told me, he was like, "You're never getting a credit card," and it was because of that, fear he probably had from seeing his dad go into so much debt, credit card debt at one point, and he's super hyper financially literate, and so with him being telling me like never get, he always told me growing up, S&P 500 and DCA and chill, and it was work, work, work. Debt is bad. 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 And so kind of having that good foundation, I guess now whenever I do stuff, it's always listening. My dad's always in the back of my head of
Mhm.
every decision I make. So whenever I make a decision financially, or even my decisions to who I see for, tonight, like for example, if somebody tells me like, hey, we're gonna do the X, Y, and Z, I always try to look at a cost benefit analysis of what's the benefit of that. Uh, and even every I'm not even joking, like every situation I try to put myself in, I always try to see what's the positives of this, what's the negatives of this, is this a good decision for my life right now and how it will benefit me.
Mhm.
And from all that stuff and surrounding myself with some good friends in high school, I guess with running cross country and track, that's my whole sports from freshman year of high school to end of the year of college. I guess a lot of cross country people worked hard because it's a hard sport, but they were also super smart. Most of them, of course, there's gonna be some outliers, but in high school, I had a small group of friends that was mostly cross country people, and literally all they would talk about is running when we would run, and then outside of practice is studying. AP classes, honors classes. That's all they want to talk about, and they would judge you basically on, did you get an A on on this test, and what's your GPA? So outside of school, I was like, all right, I gotta get a 5.0 GPA, and I got that a couple of years from high school, and then in college it was like the same thing. Though literally was super even more work ethic because you're the NCAA D1 level, and it was how hard can you work? How smart are you? Are you smart in the class? And then the third thing was most of these guys had well-off parents. I went to a school in La Jolla, San Diego. So a lot of these people had some good money. And so most of these kids kind of had a good basis for financial literacy, but most of them had investments, and some of these kids had hundreds of thousands of dollars at like 20 years old, 19 years old from their parents. In
Mhm.
terms of the people I surrounded myself with, it was great people because, when you're running cross country and track, alcohol is a bad thing. They'll make you slower. You can't stay up
Yeah.
at night and party because you have to run the next day and take care of your body and study and learn and work. I guess my foundation of life is just always making good decisions. And I feel like I've always made good decisions and looking at the pros and cons. And now post grad, it's just more of working corporately, which has been going well. But now I have I guess, full on business where no one really tells me what to do. It's kind of my own decisions that I have to make, and always learning and working hard. And I'll tell people all the time, like, if you want to get rich, you got to work hard, but you also have to invest. And if you could do both
Yeah.
those things and avoid debt, no one cares what car you drive. No one cares what clothes you wear. No one cares about the dinner you're at, the dinners, because I see on my Instagram all the time, Nobu, Mastros, they're wearing clothes, just designer clothes, they're driving the M4, driving the Mercedes or something like that's cool for a photo, but what's cooler is having a lot of money in your investment account and being able to take care of the ones you around you. Like I think that's my biggest thing is I love going to dinners with some of my best friends and just paying for them, or paying for stuff where I could give back to the people that kind of supported me. And right now my account's at almost 200,000. I turned 25 in November of this year. I want to have a quarter of a million, and I just want to this can be a outlandish claim, but I want to be a millionaire by 30. And I think that
Yeah.
if business goes
That's
well, and if I can keep on working hard, then I can get there. And from there, I could, I guess, settle down.
it grows exponentially, like more than you think it will, because you're not just gonna get money from investments. Since you're growing YouTube, you're investing in like things like Blossom and stuff like that, right? So I think that's a pretty conservative estimate, if I'm being honest. By 30, like you'll get there probably sooner than you think you will. I don't want to jinx you or anything, but you will. Do you think, like just hearing you talk, do you think psychologically you need a Mount Everest at all moments to like kind of climb? Like you're just not content of like, here's like, I hear this a lot. This is why I'm talking, baby. I'm trying to connect with you on this because this has been the vein of my thing is like, why can't you just chill? Why can't you just be happy with what you have? And you keep adding more and more difficult things that you want to accomplish. Why can't you just chill? Do you think you're one of these people that need that? Do you think you're getting your dopamine rush from hard work, from that looks difficult and hard and other people can't do it? You think you're getting from, oh, I want to learn something that's not easy to learn. I want to long distance running, do something that doesn't feel that great. Well, I'm assuming it doesn't feel that great if you're running forever. Do you think that's where your brain is hardwired? That's why you don't have the travel bug. It's you're already getting the dopamine you need. You're getting what you want. You're doing what you want, even though outside looking in looks like it's a pain in the ass.
I never thought of it like that, but I'll tell you one story before I get into that question. Was I remember we were running with my buddies, and I watched David Goggins run a 100-mile ultra marathon, and I told them, I was like, would it be kind of cool if after we graduate, while I'm still in shape, I could just run a 100-mile ultra marathon? They were like, no way, impossible. Like, we can't do that. That's not possible. And then I signed up for the race that day. And then 3 months later, when time came up for me to hang up the spikes on track, I had my first 100-mile ultra marathon where my longest run was 18 miles. And then like a week before, I just took a couple of water bottles and a couple of gels and ran 20 miles. And I was like, okay, if I get to 20 feeling super comfortable, I can maybe do this 100-mile race in one day. And then lo and behold, I ran in 21 hours, 100 miles.
Damn it.
And I guess ever since then, it's kind of been like this obsessive, maybe hard work mentality. And a lot of people ask me, I get that question like yesterday, like especially when it comes to relationships with women, of like, when are you gonna like pull the brakes, or when are you gonna like slow down or something? Because a lot of my buddies and even people know like how seriously I take stuff, whether it be like YouTube, business, or corporate. And with the goals I have, I want to achieve. It's kind of like I feel like sometimes I'm like a horse where I got blinders on and I got a goal I want to achieve. And when I have that goal and when I got the blinders and I see that I could do it, I think that that's when I just go full on laser focus and try to achieve it. And I feel like growing up, I've always liked hard things, and I've always liked things that people said that can't be done, whether it be from high school, getting a 5.0 GPA while running and whatnot. Did that, going in college and breaking a couple I broke school records in high school, broke school records, school record in college for running, and then running the 100-mile ultra marathon. Now it's being, I guess, an entrepreneur type YouTuber, and being successful with that is something that I just find so fun. I guess the hard things in life are the things that I find interest in: running, finance, and business. And I guess I get a huge rush of it. And a couple of my buddies wanted to do some vacation type stuff, but I find so much fun in doing what I'm doing. When there definitely will be a time where I kind of like pull on the brakes a little bit, but I figure, while I'm young now and I have all the energy in the world, why not just put it to, work hard for it now, and I could pull on the brakes later on. But I know how hard it is to, I guess I have a number on my mind with retirement. But
that was my next question, actually. If you want to give that, do you care to give that number or no?
I'm going to be like super, I did the math. So I have, with the money I have in my account right now and how much money I invest, by the time I'm like 59 and a half, I'll have like $20 million. I think it's $22 million in investing if I keep up this investments and how much money I have now. But that's assuming I also don't invest more money.
Yeah.
But I don't know. I have a good head on my head, but also my dad, I would say, is multi-millionaire too. And I guess to just maybe I'm like a spitting image of my dad. But instead of him, he's full on consulting and being a managing partner at a firm. And I want to do the finance route and entrepreneurial route as well. And I don't know. I think that's my number, and I feel like that's something I'm comfortable with. But I also have huge goals with the family I want to have and house I want to live in, and thinking about what kind of car I want to drive, and I want to be that type of person that I have money to give and it's not going to be a problem, and kind of helping others. So that's why I love to invest, and that's kind of why I have these huge goals.
You mentioned like you're hyper competitive. You're super, like, you have a lot of drive from a young age. Slightly different there. I'm obsessive, right? So you get an, I think like I'll lose sleep over like, I got to get this. We're talking a little bit before off camera, like, where am I trying to take my YouTube channel? I'm just going to go crazy until I get to that point, right? So it's like stuff like that. And that's the only thing. That's the reason why I'm successful. It's not because I'm uniquely skilled anywhere. I'm actually not the brightest, not an athlete like yourself. Not really. If you put dictionary, and I think this is why I like investing, and this is not talking to all my investors out there, it's I can be completely average in every area, mentally, physically, everything. And I can just do some basic shit and I can still come out a millionaire. In advertising, there's a term they go, the secret sauce. They got the secret sauce. Here's an advertising campaign that'll get you all your clients. It'll get you all the sales, but there is no secret sauce. I felt like in life, investing was the secret sauce. It was purposely made to look complicated so everyone doesn't figure out how easy it really is. And we can just keep this is my whatever conspiracy hat. Let's put it on. Okay. But it purposely don't teach people about it. Keep everyone poor and stupid, buying shit that they don't need. Like you mentioned before, buy a super expensive car, pay $700 a month on the car loan, buy a bunch of crazy clothing, try to look cool in front of people because you saw it in your music video. All the stuff that doesn't matter, rather than just putting aside money, not getting it into the stock market, not getting into debt. If you have a credit card, only using it to build credit. It's just a tool you use to build credit, so then you can get, a home down the line earlier or whatever you want. That's all it is. It's not even there to buy stuff. It's just there to build credit. And then you can go out with dinner with your friends and buy a $300 meal if you want to, and not even bat an eye, because you're like, yeah, because you have that, and you're working a job that pays decent, not even crazy. It's just you're so good with finances and you know where all your money's going. You can drop $300 on a dinner because you don't have a car loan, you don't have all this other crap. You can enjoy yourself in that moment. You have no stress that in 20 years, even if you don't get any better at your career, you'll still come out with $3 million because you invested correctly. And that was the realization. I went on a tangent, but the realization was I could have worked at McDonald's from the moment I was 18 to now I'm 39, and just invested a portion of my paycheck working at McDonald's that whole time, and I would have been a millionaire right now, just doing that. Instead, I had to do all this other hard stuff because I didn't know about investing at a young age. When you're talking to like newer investors on my channel, what are like the fundamentals you just want people to take away from investing? As far as, we open up with like, is it just, hey, just buy VOO or just buy a sort of worldwide ETF? Like we have a couple here in Canada called XEQT, VEQT. It's like, what's your honest suggestion for it? Let's tie it all back together. Brand new investor, never invested, doesn't want to be hands-on. So doesn't want to look at, and they're only willing to do dollar cost averaging. What is your suggestion for like, hey, you're in your 20s or 30s, what strategy are you giving them that's safe? That's a safe strategy.
Yeah. So if we're talking about step one is opening up or maxing out your tax advantage accounts. So in America, we got Roth IRA, and then we have 401k, where we could do a Roth 401k or 403b. And the reason why you want to max those out was because you could get some sort of upfront tax benefit. And with the 401k especially, which is what I try to do, is I try to max it out. Well, this year I'm trying to max it out so I could, reduce my tax liability, contribute to investments specifically for retirement. And also with 401ks, most companies do a match. So mine is, I believe, 6% match. So if I put in, let's say I make $100,000 a year, 6% of $100,000 would be $6,000. So the company will give you $6,000 to invest in that account, assuming whether or not you contribute to it, but most people do. So you could compound your returns more because you get that free money and then get that upfront tax liability. Then of course you could do it in a Roth version, which means you're going to be paying taxes now and not later. And the reason why, I love a Roth IRA, for example, is because you could get tax-free in dividends, which is super important because most dividends are subject to either qualified dividends, unqualified dividends, ROCs. You get super complex, but with a Roth IRA, you get tax-free dividends and tax-free capital gains on any gains you have in your stocks or ETFs, even crypto, in retirement, which is age 59 and a half. Most people go, I guess, three directions. You want dividends, which means you prioritize taking income at some point before you retire, or even in retirement. That should be your main way of retiring, or basically capital appreciation or some sort of growth, which is going to be your typical S&Ps, your NASDAQ 100s, or just your pure growth or tech funds. And if I were to choose, optimal strategy for anybody, beginner investor, super safe, either it would still be these two. It would be buy the S&P 500, whether it be Canadians for VFE or the RSP, you could do VOO, and just buy and hold it, contribute to it, don't look at it. Whenever you get paid, just have it on autopilot and then turn on drip. So any sort of distribution of the dividend automatically buys more. So I would buy an S&P 500 index fund or an ETF like that. Or you could do something like, if you want to really sleep at night, because, people argue that America, one day might not be the superpower and international might take over. So if you want to hedge yourself from any sort of concentration risk to US, of course, there's something called, I forget the term, but globalization, which means that, most of these companies take earnings internationally. So you would say that they're internationally exposed, but buy a total world ETF. So you have emerging markets, you have developed markets, you have US stocks. You have small caps, mid caps, large caps. So it would be something like VT for Americans or XEQT for Canadians
Yep.
and whatnot. Those would be my optimal strategies. And you can honestly just do that and be on autopilot. And then my next tip I tell people is once you got that set up, you got your strategy down, you got your drip on autopilot, contribution on autopilot, is go out and make more money. So if you want to retire faster, richer, you got to make more money. You got to invest more money. If you want to compound your returns more, invest more. You go on to play around with a compound interest calculator, and if you invest just $100 more a month, your returns could be exponentially more than the person who invests in less money. And then people always get freaked out of, oh, like if I just went all in on, on this stock or this ETF, it got 4% more returns than this one a year. And I'll tell people you could beat them if you invest more money.
Mm-hmm.
So,
Mm-hmm.
don't look at that person who got like a 500, or a 500% gain in 5 years, and then you're only getting like 350, because you never know how much money they're investing. If they're investing not a lot of money, you're outperforming them. If you're investing more money, you're keeping up or even outperforming them. And then if you're getting the same return, but you're the guy that's investing more money, making more money, providing more value to the economy, you're going to be just fine come your 40s, 50s, or your 60s and whatnot.
Yeah, you're definitely one of my favorite guys on YouTube when it comes to financial content. I learned plenty from you still. Appreciate you putting out good stuff, and we'll talk soon. Later, brother.